It's late. You're lying in bed, phone screen bright in the dark, and you've just watched another video about passive income. $3,000 a month. That's the number everyone throws around. Quit your job. Live freely. Let your money work for you. But nobody ever tells you what it actually takes to get there. Not in Australia. Not with real tax rates. Not with real investment vehicles. Not with the actual numbers behind the dream. That's what this video is. By the end, you'll know exactly what a $3,000 a month passive income stream requires, depending on how you build it. And I'm going to give you the real figure, not the one the influencers use, but one that actually holds up. Let's start with why $3,000 a month matters. After tax, $3,000 a month is $36,000 a year. That's roughly in line with what a single person needs to live modestly in Australia. Not comfortably, but without panic. Cover rent somewhere affordable, food, transport, utilities, and a small buffer. It's not retirement money for Sydney, but it's the number that makes a second income real. For most working Australians, $3,000 a month in passive income means you've bought yourself options. You could drop to part-time. You could weather a redundancy. You could stop trading time for money, at least partially. So the question isn't whether $3,000 a month is worth chasing. It is. The question is what it actually costs to build. Path 1. High-yield savings and term deposits. Let's start with the simplest option, because most people ask about it first. At current rates, a high-yield savings account in Australia is paying around 5% per year. A term deposit is similar, somewhere between 4.5% and 5.2%, depending on the term and the institution. To generate $36,000 a year at 5%, you need $720,000 sitting in cash. That's the number, $720,000. And here's the catch that wrecks this path for most people. That $36,000 is taxed as ordinary income. If you're still working and earning $90,000 a year, your marginal rate on that interest income is 34.5%, including the Medicare levy. You're not keeping $36,000, you're keeping closer to $23,600. To actually receive $3,000 a month after tax in this scenario, you'd need roughly $1.1 million in a savings account. Savings accounts are not a passive income vehicle. They're a holding pattern. Path 2. ASX dividend ETFs with franking credits attached. This is where it starts to get interesting. Australian dividend ETFs like VHY, Vanguard's High Yield ETF, or A200 from BetaShares are built around ASX companies that pay regular dividends. VHY currently yields around 5.5% to 6% in dividends, and many of those dividends come with franking credits attached. Franking credits are the part most people skip over, and they're powerful. When an Australian company pays a dividend, it's already paid 30% corporate tax on those profits. The franking credit represents that tax payment and is passed on to you. If your personal tax rate is lower than 30%, you get the difference back as a refund. Let's run the numbers. To generate $36,000 a year in dividends at a 5.5% yield, you need a portfolio of around $655,000. But with a fully franked dividend, the grossed up yield, the dividend plus the franking credit, is closer to 7.8%. At that rate, you're looking at a portfolio of around $460,000 to deliver $36,000 in actual cash, plus a tax refund at the end of the year. If passive income is your primary income and you're below the $45,000 tax threshold, you may pay very little tax at all. And if your taxable income is low enough, the ATO refunds you part of the franking credits in cash. That refund isn't theoretical, it shows up in your bank account. For someone living primarily on ETF dividends in Australia, the effective portfolio requirement to clear $3,000 a month after tax can be as low as $500,000 if the portfolio is well structured and franking credits are factored in properly. That's a dramatically different number than the cash savings path. Path 3. Residential property rental income. Property is the path most Australians default to when they think passive income. It's familiar, it feels real, you can touch it. But the yield math is brutal. Gross rental yield on Australian residential property is typically 3% to 4% in capital cities. In Sydney, it's closer to 2.8%. In Brisbane, you might find 4%. In regional areas, sometimes higher. Take a $700,000 investment property in Brisbane at a 4% gross yield. That's $28,000 a year in rent before you've paid a single bill. Now subtract council rates, water, landlord insurance, property management fees at around 8% to 10% of rent, maintenance, vacancy periods, and land tax if it applies. You're realistically netting 2.5% to 3% after costs. On a $700,000 property at 3% net yield, you're left with $21,000 a year. That's $1,750 a month. To hit $3,000 a month in net rental income, you're looking at either a $1.2 million property portfolio or exceptional yield properties that are increasingly hard to find near any major population centre. And that's before the mortgage. If you have debt on the property, the cash flow picture gets worse. Property can build wealth, but as a pure passive income vehicle, it underdelivers dramatically against what people expect. Path 4. The mixed portfolio approach. Here's what actually works for most people. Instead of going all in on one vehicle, the most realistic path to $3,000 a month combines ETF dividends, a small fixed income allocation, and potentially one income-producing asset, whether property or an investment bond. A rough structure that many Australian investors land on looks like this. A core ETF portfolio of around $400,000 in broad and high-yield ASX ETFs, generating 5.5% to 6% in dividends. That delivers roughly $22,000 to $24,000 a year, with franking credits pushing the effective value higher. A secondary allocation of $150,000 in bonds or a term deposit ladder generating 4.5%, that's another $6,750 a year in steady, predictable income. Together, that's a $550,000 portfolio delivering close to $30,000 a year before franking credit refunds. With franking credits applied, and assuming this is your primary income, you're clearing $3,000 a month or very close to it. $550,000 is still a significant number, but it's a long way from the $1.1 million you'd need in a savings account, and it's achievable on a middle Australian income over a 10 to 15 year period of consistent investing. Here's the thing most people completely miss. The franking credit refund is not a bonus. It's not a technicality. It's a structural feature of the Australian tax system that materially changes the maths of dividend investing. If your income is entirely from fully franked dividends and you're below the $45,000 threshold, you could receive a tax refund of $5,000 to $8,000 a year in cash simply from credits that were attached to dividends you already received. That's an extra $400 to $650 a month in effective income that most passive income calculators never include. It's not a loophole, it's the system working as designed. And Australians who understand it build their portfolios around it on purpose. So here's the real answer. $3,000 a month in passive income is not one number. It's 4 different numbers depending on how you build it. Via cash savings, you need $1.1 million or more. Via property alone, you need $1.2 million in property assets, net of debt. Via ETF dividends with no franking benefit, you need around $655,000. Via a franking optimised ETF portfolio as your primary income, you need closer to $500,000 to $550,000. The people who get there fastest are the ones who stop thinking about passive income as a lifestyle concept and start thinking about it as a tax-optimised portfolio construction problem. You don't need to earn more, you need to structure it correctly. Go back to that phone screen in the dark. Now you have the actual number. What you do with it is up to you. If this gave you a clearer picture than anything else you've watched on this, hit like and subscribe. New videos every week, built around the real numbers of Australian personal finance. Turn on notifications so you don't miss the next one.